At the start of a new year, many people resolve to finally do something with their money. But for many first-time investors, biggest risk isn't losing money. It's being so afraid of getting it wrong that they never start or quit too early. Over time, the fear can cost beginners more than a single bad decision. Like many in their 20s, Cheng Kai-si knows she should start investing. But with so much advice online, the 26-year-old is unsure what her first move should be. To avoid the mistakes that trip up most beginners, she turns to financial planner Alvin Chow. One of the most common mistakes first-time investors make isn't choosing the wrong investment. It's investing money they might need too soon.
One of it is the emergency cash. And typically people would look at 6 months of emergency cash that is being kept as liquid cash in any account, and so that in case there is really an emergency, this cash can be used. So once that's done, I also think that the protection part is important. That is related to insurance. Then the third one would be, I believe in automating investment process. That means having a structure rather than relying on self-discipline to do your investments. And also follow the principle of pay yourself first. That means we should invest first, then spend the rest. And how I would typically advise people to do is to set up an automated money investment plan with a platform.
Kai-si has saved enough for her emergency fund, so feels ready to build her first investment portfolio.
If I have $10,000 in hand, how can I structure my first investment portfolio?
I would suggest something that's globally diversified, right? And a mix of stocks and bonds. So 60-40 is usually a very good balance to start off with. And if, let's say, a market crash happened, and this investor feel that, oh, I cannot suffer this drop in my portfolio value, then it's time to increase the bond allocation, right? Maybe 40% is too low, maybe flip 60% into bonds, 40% into stocks, right? So this recalibration process is an ongoing process until the investor discover the actual risk tolerance that he can accept.
The takeaway for first-timers: starting conservatively means you avoid having to learn about risk tolerance the hard way. That can help you stay invested long enough to stay the course. Alvin says another trap beginners fall into is trying to make money quickly.
So I think one of the biggest mistakes is that for young investors, due to a smaller capital amount, they tend to take undue risk, right? That's how a lot of youngsters get drawn to like cryptocurrencies or leverage trading, those kind of highly leveraged options. And there's also another group of investors, they play it too safe, right? Because probably they hear a lot of sob stories, they're also very scared, right? Oh, this guy lost a lot of money, I better be careful. And that becomes inaction. So for this group, definitely taking action is the very first step, right? If, let's say, investing even $1,000 is daunting, okay, what one can do is invest, say, $100 every month. Okay, start small and increase the amount as one gets more confident or comfortable, right? But the first step must be done.
Online, lump sum versus dollar cost averaging sparks endless debate. Studies do show that lump sum investment beats dollar cost averaging most of the time. But for beginners, there's a simpler question. Which approach helps you stay invested?
So I would say that dollar cost averaging is still a very valid, systematic and very disciplined way of investing. So one should still have that part. So which means any individual should do both, lump sum and dollar cost averaging. Right? Dollar cost averaging is a very consistent monthly investment, and then lump sum could be once in a while you get a bonus and you didn't spend everything, and that's where you can put more into the market in a lump sum manner.
So when is a good time to enter the market, or is there even such a thing as a right time to enter the market?
Of course, if we know when is the bottom of the market, we would be able to time it very well, right? We will buy at the real bottom of the market, but unfortunately, we won't know when is the bottom or when is the market is going to crash. But usually, what I observe is that people are too scared to do anything, and they just watch the opportunity goes by, right? So because of that, that's why I say that don't try to really optimize the entry or the timing of it. And if you really have a long-term horizon, the earlier you buy, the better it is for the compounding effect to start.
For new investors, another hidden mistake is watching prices too often. It turns long-term plans into emotional decisions. Alvin's tip is to rebalance once a year to keep risk in check. Doing it too often just adds stress and costs. Another mistake first-time investors often overlook isn't emotional. It's invisible. Fees don't feel painful at the start, but over time, they quietly eat into returns. On a $100,000 investment earning 4% a year, paying a higher annual fee of 1% instead of 0.25% can reduce returns by close to 14% over 20 years. So keeping costs low matters. Because unlike markets, fees are guaranteed, and once paid, you never get them back. For first-time investors, the goal isn't to be clever. It's to build a habit they won't quit when things get uncomfortable. So this year, Kai Si's first move isn't picking the perfect product. It's starting with a plan she can stick to beyond January.